Hello everyone, this is Andrew McNair from Swan Capital with our July 2023 Swan Report. In this month's video, we're going to discuss some recent headlines that influence the financial markets. But I want to provide you some perspective and distill all of this information so that as an investor, you can use it over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. At Swan Capital, our market outlook remains positive because of lower inflation and the technological advances that we're seeing in things like drones as well as 3D printing. It's a really exciting time to be alive. But markets ended the first half of the year on a winning streak. We had a lot thrown at us in the first half of 2023, and after a miserable year, markets picked themselves up from the lows of October 2022 to advance over 20% as measured by the S&P 500. Now, year to date, the S&P 500 is up just over 15%. The Fed's continued rate increases, inflation has come down but remains sticky. And so we have constant imminent recessionary fears, regional bank failures, and the debt ceiling fight were all hurdles that the market had to jump over and over again to negotiate this 15% return. The markets and the economy both seem to have hung in there despite the Fed's determination to slow job growth and curb inflation as it tries to avoid this recession that seems to be talked about over and over again on the news. Now, the rest of the market has only recently begun to move upward. That is still progress, and with all the challenges of the first half of the year behind us, it's hard to imagine a more difficult second half. There are bound to be developments as well as challenges ahead, but this solid start to the year, despite all the potential negativity, will hopefully spark the follow-through for a strong ending to the rest of 2023. Now, I would be remiss if we did not talk about the Federal Reserve. All eyes are on the Federal Reserve during this period of rate increases. We have a big emphasis on the Fed that I think is unhealthy. But the latest Federal Reserve meeting minutes were released earlier this month, and members pretty much completely agreed on the need for additional rate hikes, virtually guaranteeing at least a one-time 25 basis points increase at their next meeting. But that doesn't mean that the Fed is over. This, plus the jobs data, cemented what the markets largely expected and have already priced in. Now the worry will likely be how many more hikes we can expect before the Fed puts the brakes on. Just like last summer, we talked about rate cuts by year end, and that has come and gone like a sudden summer afternoon thunderstorm. The market has priced in 2 more rate hikes of 25 basis points, and if we don't see significant improvement in CPI talks, this will probably turn to a possibility of a 3rd rate hike in 2023. So just like the thirsty desert wanderer looking for some water, the Fed is drawn to a mirage it sees as an oasis in the inflationary landscape that we're living through. Robust job growth continues to confound the Fed, and there aren't any signs of letting up. But is the Fed looking at a mirage? The ADP National Employment Report came in at a very strong 497,000 jobs, more than doubling the estimate of 228,000 jobs, and hitting the highest reading since February 2022. So according to ADP, job creation surged in June, led by consumer-facing services. Now, leisure and hospitality, trade and transportation, and education all showed strong gains too. Now, still, the market was fragmented with manufacturing, information, and finance showing declines. As a result, the pace of growth is likely not sustainable. Nearly half of the new jobs were in leisure. Once people are done traveling and eating out and credit card bills start to pile up, those higher interest rates combined with those balances create pressure for the average consumer. And guess what will happen? Airlines and hotels and restaurants will have to lay off some of those workers. These are not sticky professional jobs. The other thing that we need to keep an eye on is wage growth, which is at 4.4%. That's barely keeping pace with current inflation levels. So the Fed will see this job growth, not for the mirage it is. Now is finally the appropriate time for the word transitory. But they may instead see it as a green light to combat inflation via higher interest rates. The problem is that once they mostly stopgap jobs are no longer needed, the Fed will put us in a more difficult position by having raised and keeping rates at a level that will hurt economic activity and really hamper growth. The Fed is fixated on the jobs growth number and the unemployment rate, and they're using the data to cover and justify raising interest rates further. The problem is that these jobs can evaporate very quickly, like water in the desert. But the Fed will likely go too far before it realizes that these jobs were just a mirage. So the Fed is playing a very dangerous game, and I believe that our economy has too big of an emphasis on the Fed, which I believe will cost us in the long run because they won't be able to land this plane just right. That's it for this month's Swan Report, but I want to thank you for listening every month to the Swan Report, and be sure to get your ticket to the Halftime Report, which will be August 5th, live in Pensacola, Florida at the Rex Theater. We will produce a recorded version at 4 different camera angles in 4K, so it'll feel like you're there if you can't make it, but we would love to see you at the Halftime Report. If you have questions about your personal financial situation, please give us a call at 850-380-9558. And also be sure to RSVP for the Halftime Report by calling the same number at 850-380-9558. We'll see you next month.